Question 1. To address the challenge of a client expressing a strong desire for an investment strategy that appears to carry a significantly higher risk than their previously established risk profile suggests, what is the most appropriate course of action for an advisor? Option A. Immediately implement the client's requested strategy, assuming they have fully considered the risks and are making an informed decision. Option B. Advise the client that their request is too risky and refuse to implement it without further discussion, potentially alienating the client. Option C. Suggest a slightly modified version of the client's requested strategy that reduces risk marginally, without fully exploring the client's underlying motivations or the full spectrum of suitable options. Option D. Conduct a comprehensive review of the client's current financial situation, risk tolerance, and investment objectives, and then engage in a detailed discussion with the client about the implications of their desired strategy, including potential downsides and alternative suitable options. The correct answer is D. Conduct a comprehensive review of the client's current financial situation, risk tolerance, and investment objectives, and then engage in a detailed discussion with the client about the implications of their desired strategy, including potential downsides and alternative suitable options. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for a specific investment outcome and the advisor's duty to act in the client's best interest, adhering to regulatory requirements. The advisor must navigate the client's emotional state and potential misunderstanding of risk versus reward, while upholding their fiduciary responsibilities. Careful judgment is required to balance client satisfaction with regulatory compliance and ethical conduct. The correct approach represents best professional practice because it prioritizes the client's long-term financial well-being and regulatory adherence. By conducting a thorough risk assessment, understanding the client's true objectives beyond their immediate stated desire, and explaining the implications of different investment strategies in a clear, unbiased manner, the advisor fulfills their duty of care and suitability. This aligns with the core principles of investor protection mandated by regulatory frameworks, ensuring that recommendations are appropriate for the client's individual circumstances, risk tolerance, and financial goals. An incorrect approach that focuses solely on fulfilling the client's immediate, potentially ill-advised request without proper due diligence would be professionally unacceptable. This would constitute a failure to act in the client's best interest and could lead to unsuitable investments, exposing the client to undue risk. Such an action would violate regulatory obligations regarding suitability and fiduciary duty, potentially resulting in disciplinary action, fines, and reputational damage. Another incorrect approach, which involves pressuring the client into a more conservative strategy than they desire without adequately explaining the potential benefits of a slightly higher risk profile, if appropriate for their goals, also falls short. Appearing to be cautious, this can be paternalistic and may not align with the client's true risk appetite or long-term objectives, potentially leading to missed opportunities and client dissatisfaction. It fails to engage the client in a collaborative decision-making process. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client. Deeply explore the client's stated goals, underlying motivation, financial situation, and risk tolerance. 2. Assess suitability. Evaluate investment options against the client's profile, considering risk, return, liquidity, and time horizon. 3. Educate and explain. Clearly articulate the risks and potential rewards of various strategies, ensuring the client comprehends the implications. 4. Document thoroughly. Maintain detailed records of all discussions, recommendations, and client decisions. 5. Act in best interest. Always prioritize the client's financial well-being and regulatory compliance over immediate client demands or advisor incentives. Question 2. Governance review demonstrates that a senior colleague has instructed a junior employee to expedite the onboarding of a new high-net-worth client by bypassing certain standard Know Your Customer (KIC) documentation checks, stating that the client is well known and the checks can be completed retrospectively. The junior employee has a strong understanding of the firm's onboarding procedures and the regulatory requirements for client due diligence. What is the most appropriate course of action for the junior employee? Option A. Complete the onboarding process as instructed, assuming the senior colleague has the authority to waive certain procedures for this specific client. Option B. Politely decline the instruction to bypass the KYC checks, explain the regulatory and policy implications, and offer to assist in completing the necessary documentation promptly through the standard process. Option C. Inform the senior colleague that the instruction cannot be followed due to potential regulatory breaches and immediately escalate the matter to the compliance department. Option D. Proceed with the onboarding as instructed, making a mental note to complete the missing KYC documentation at a later date to avoid delaying the client. Correct answer is B. Politely decline the instruction to bypass the KYC checks, explain the regulatory and policy implications, and offer to assist in completing the necessary documentation promptly through the standard process. Explanation. This scenario presents a professional challenge because it requires an individual to navigate a conflict between a direct instruction from a senior colleague and their own understanding of regulatory obligations. Pressure to comply with a superior's request, especially when it appears to expedite a process, can be significant. However, adherence to regulatory frameworks is paramount in the financial services industry to maintain market integrity, protect investors, and ensure the firm's reputation. The correct approach represents best professional practice because it prioritizes regulatory compliance and ethical conduct over immediate expediency or personal convenience. By seeking clarification and adhering to the established procedures for client onboarding, the individual upholds their duty to the firm and its clients, as well as their professional responsibilities under the relevant regulatory framework. This demonstrates a commitment to the principles of treating customers fairly and integrity, which are foundational to the CRRC hiring assessment test's expected standards. Specifically, it aligns with the expectation that all staff understand and apply the firm's policies and procedures, which are designed to meet regulatory requirements. An incorrect approach that involves bypassing the standard Know Your Customer (KIC) checks would represent a significant regulatory and ethical failure. This would violate the firm's internal policies, which are in place to comply with anti-money laundering (AML) and counter-terrorist financing (CTF) regulations. Such a failure could expose the firm to substantial fines, reputational damage, and legal repercussions. It also demonstrates a lack of integrity and a disregard for the professional standards expected of individuals working within the regulated financial sector. Another incorrect approach, which involves proceeding with the onboarding without the necessary documentation, but making a mental note to follow up later, is also professionally unacceptable. While it might seem like a compromise, it still constitutes a breach of regulatory requirements. The risk of forgetting or the documentation never materializing remains, and the firm would have onboarded a client without fulfilling its due diligence obligations. This approach shows a lack of diligence and a willingness to take on undue risk. The professional decision-making process for similar situations should involve a clear understanding of the firm's policies and procedures, as well as the relevant regulatory obligations. When faced with a request that appears to conflict with these, the professional should 1. Pause and assess the request against their knowledge of regulations and internal policies. 2. If there is any doubt or perceived conflict, seek clarification from the instructing colleague or escalate the matter to their compliance department or supervisor. 3. Never proceed with an action that they believe violates regulatory requirements or internal policies, even if instructed to do so by a senior. 4. Document all communications and decisions made in such situations. Question 3. Process analysis reveals that a financial services firm is seeking to optimize its client onboarding procedures to improve efficiency. The firm is considering different approaches to customer due diligence, CDD, in line with its obligations under UK financial crime regulations. Which of the following approaches best balances regulatory compliance with operational efficiency? Option A. Implementing a risk-based CDD framework, where the level of due diligence is proportionate to the assessed risk of the client, with enhanced measures for high-risk clients. Option B. Prioritizing the speed of client onboarding above the thoroughness of due diligence, especially for clients identified as potentially high risk. Option C. Relying exclusively on automated CDD checks without any human review or escalation protocols. Option D. Applying a standardized, identical level of due diligence for all clients to ensure consistency and simplicity. The correct answer is A. Implementing a risk-based CDD framework where the level of due diligence is proportionate to the assessed risk of the client, with enhanced measures for high-risk clients. Explanation. Scenario analysis. This scenario presents a common challenge in regulatory compliance, where a firm must balance the need for efficient client onboarding with the stringent requirements of anti-money laundering (AML) regulations. The pressure to onboard clients quickly can lead to shortcuts, potentially compromising the thoroughness of due diligence. The professional challenge lies in adhering to the spirit and letter of the law while maintaining business objectives, requiring careful judgment and a robust understanding of regulatory expectations. Correct approach analysis. The correct approach involves implementing a risk-based due diligence process that is proportionate to the identified risks. This means that while all clients require a baseline level of checks, high-risk clients, e.g., those in high-risk jurisdictions, politically exposed persons, or those involved in complex transactions, must undergo enhanced due diligence (ED). This aligns with the principles of the Proceeds of Crime Act 2002 and the Money Laundering, Terrorist Financing and Transfer of Funds, Information on the Payer, Regulations 2017, which mandate a risk-based approach to customer due diligence (CDD). EDD ensures that the firm gathers more comprehensive information and conducts more frequent monitoring for high-risk clients, thereby mitigating the increased risk of financial crime. Incorrect approaches analysis. An approach that mandates the exact same level of due diligence for every client, regardless of risk, is inefficient and potentially non-compliant. It fails to allocate resources effectively and may not provide sufficient scrutiny for high-risk individuals or entities, thereby increasing the firm's exposure to financial crime. This deviates from the risk-based principle embedded in UK AML regulations. An approach that relies solely on automated checks without any human oversight or the ability to escalate for further investigation is also problematic. While automation can streamline processes, it may miss nuances or red flags that trained compliance professionals would identify. Regulations require a degree of professional judgment and the ability to adapt due diligence based on evolving risk factors. An approach that prioritizes speed of onboarding over the completeness of due diligence, even for high-risk clients, represents a significant regulatory and ethical failure. This directly contravenes the core objectives of AML regulations, which are designed to prevent the financial system from being used for illicit purposes. Such an approach would expose the firm to severe penalties, reputational damage, and potential criminal liability. Professional reasoning. Professionals should adopt a framework that begins with understanding the firm's regulatory obligations under UK law, particularly the Proceeds of Crime Act 2002 and the Money Laundering regulations. This involves developing and implementing a clear, risk-based CDD policy and procedure. When onboarding a new client, the first step is to assess their risk profile based on predefined criteria. For low-risk clients, standard CDD measures may suffice. For medium and high-risk clients, enhanced due diligence measures must be applied, which may include obtaining additional information about beneficial ownership, source of funds, and the purpose of the business relationship, as well as conducting more frequent reviews. Crucially, there must be a clear escalation path for any identified red flags or anomalies involving experienced compliance personnel. Continuous training and updates on evolving money laundering typologies and regulatory changes are also essential to maintain an effective compliance program. Question 4. The performance metrics show a significant increase in new client account opening requests, leading to a backlog. A senior team member suggests expediting the process by temporarily relaxing the standard Know Your Customer (KIC) and suitability checks for a subset of incoming clients, arguing it will improve client satisfaction during this peak period. What is the most appropriate course of action to maintain regulatory compliance? Option A. Temporarily relax certain KYC and suitability checks for clients identified as having lower risk profiles to expedite onboarding. Option B. Delegate the full responsibility of reviewing and approving expedited client accounts to a junior compliance officer to manage the workload. Option C. Implement a streamlined but still compliant KYC and suitability process that prioritizes speed while ensuring all essential information is gathered. Option D. Adhere strictly to all established KYC and suitability procedures for every new client account, even if it means a temporary increase in processing times. The correct answer is D. Adhere strictly to all established KYC and suitability procedures for every new client account, even if it means a temporary increase in processing times. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient client service with the stringent regulatory obligations surrounding client onboarding and suitability. The firm's reputation and regulatory standing are at risk if client accounts are opened without adequate due diligence, even if the intention is to expedite service during a busy period. The core tension lies between operational expediency and robust compliance. The correct approach represents best professional practice because it prioritizes adherence to the CRRC regulatory framework for client onboarding and suitability assessments. This ensures that all clients are properly vetted, their investment objectives and risk tolerance are understood, and the firm is acting in their best interests, thereby fulfilling its fiduciary and regulatory duties. This proactive compliance minimizes the risk of regulatory breaches, client complaints, and reputational damage. An incorrect approach that bypasses or shortcuts the Know Your Customer kick and suitability procedures is professionally unacceptable. This failure directly contravenes CRRC regulations that mandate thorough client due diligence before account opening and before recommending any financial products. Such a shortcut exposes the firm to significant regulatory penalties, including fines and potential suspension of operations, and breaches ethical obligations to clients by potentially offering unsuitable investments. Another incorrect approach that relies solely on a junior staff member to retrospectively review documentation without proper oversight or adherence to established procedures is also flawed. This demonstrates a lack of robust internal controls and a failure to ensure that compliance standards are consistently met, increasing the likelihood of errors and omissions that could lead to regulatory issues. Professionals should employ a decision-making framework that begins with identifying the core regulatory requirements applicable to the situation. This involves understanding the specific CRRC rules regarding client onboarding, kick, and suitability. Next, assess the potential risks associated with any proposed deviation from these rules, considering both regulatory and ethical implications. Prioritize compliance and client protection over short-term efficiency gains. If operational pressures are causing delays, the appropriate response is to seek additional resources or implement process improvements within the regulatory framework, rather than compromising on essential compliance steps. Question 5. Consider a scenario where a financial advisory firm, regulated by the CRRC, has a long-standing client whose recent transaction patterns have become unusually complex and involve multiple international transfers to jurisdictions known for higher money laundering risks. The client has provided vague explanations for these transactions, citing investment diversification. The firm's compliance officer is concerned about potential money laundering or terrorist financing activities. What is the most appropriate course of action for the firm to take? Option A. Conduct a thorough internal investigation to gather more information and assess the legitimacy of the transactions, consulting with the firm's compliance department and legal counsel before making any reporting decisions. Option B. Ignore the unusual transaction patterns, given the client's long-standing relationship and perceived trustworthiness, to avoid disrupting the business relationship. Option C. Discreetly advise the client to move their funds to another institution to avoid further scrutiny and potential complications for the firm. Option D. Immediately file a suspicious activity report, SAR, with the relevant authorities based on the unusual transaction patterns and the client's vague explanations. The correct answer is A. Conduct a thorough internal investigation to gather more information and assess the legitimacy of the transactions, consulting with the firm's compliance department and legal counsel before making any reporting decisions. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The firm is entrusted with sensitive client information, creating a duty of loyalty and discretion. However, regulatory frameworks, such as those overseen by the CRRC, mandate proactive measures against financial crime. Navigating this requires a nuanced understanding of when the presumption of client innocence is superseded by concrete indicators of illicit activity, demanding a careful balancing act between professional duties. The correct approach represents best professional practice because it prioritizes adherence to the CRRC regulatory framework for anti-money laundering (AML) and counter-terrorist financing (CTF). Specifically, it involves a thorough internal investigation to gather sufficient evidence that moves beyond mere suspicion to a reasonable belief of criminal activity. This aligns with the principle of proportionality in reporting, ensuring that the significant consequences of a suspicious activity report (SAR) are not triggered by unsubstantiated conjecture. It also respects client confidentiality until such a point where regulatory obligations necessitate disclosure. This methodical approach demonstrates due diligence and a commitment to both client trust and regulatory compliance. An incorrect approach that involves immediately filing a SAR based solely on the client's unusual transaction patterns, without further internal investigation, fails to meet the threshold for reporting. This could lead to unnecessary disruption for the client and strain on regulatory resources, potentially violating principles of fairness and proportionality. It also risks breaching client confidentiality prematurely, which could have legal and reputational repercussions for the firm. Another incorrect approach, which is to ignore the unusual transaction patterns due to the client's long-standing relationship and perceived trustworthiness, represents a significant regulatory and ethical failure. This demonstrates a dereliction of duty under AML/CTF regulations, which require vigilance regardless of client history. It exposes the firm to severe penalties for noncompliance and could inadvertently facilitate financial crime, undermining the integrity of the financial system. A third incorrect approach, which is to discreetly advise the client to move their funds to a different institution to avoid further scrutiny, is ethically reprehensible and a direct violation of regulatory obligations. This constitutes tipping off, a serious offense that obstructs regulatory investigations and can be interpreted as aiding and abetting financial crime. It is a clear abdication of the firm's responsibility to report suspicious activities and a betrayal of trust placed in them by both clients and regulators. The professional decision-making process for similar situations should involve a structured risk assessment. First, identify the potential red flags and assess their significance in the context of the client's profile and the firm's AML/CTF policies. Second, conduct a proportionate internal investigation to gather further information and corroborate or refute the initial suspicions. Third, consult with the firm's compliance officer or legal counsel to determine if the gathered evidence meets the reporting threshold as defined by CRRC regulations. Finally, if the threshold is met, proceed with filing a SAR in accordance with established procedures, ensuring all documentation is accurate and complete. If the threshold is not met, document the findings and continue to monitor the client's activity. Question 6. The investigation demonstrates that a financial advisor received a valuable gift from a third-party investment product provider, whose offerings the advisor frequently recommends to clients. The advisor believes the gift will not influence their professional judgment. What is the most appropriate course of action according to CRRC regulatory framework and ethical guidelines? Option A. Refuse the gift immediately without any further action, to avoid any perception of impropriety. Option B. Accept the gift and only disclose it to the client if specifically asked about vendor relationships. Option C. Accept the gift and assume it does not impact professional judgment, as long as no explicit quid pro quo was discussed. Option D. Disclose the gift to the client and obtain their informed consent regarding the continued use of the provider's products. The correct answer is D. Disclose the gift to the client and obtain their informed consent regarding the continued use of the provider's products. Explanation. The investigation demonstrates a scenario where a financial advisor, acting on behalf of a client, has received a significant gift from a third-party vendor, whose products the advisor frequently recommends. This situation presents a professional challenge due to the inherent conflict of interest it creates. The advisor's duty of loyalty and care to the client is paramount, and any external benefit that could influence their professional judgment must be carefully managed. The core issue is whether the gift compromises the advisor's objectivity and potentially leads to recommendations that are not solely in the client's best interest, but rather influenced by the personal gain received. The correct approach, which involves disclosing the gift to the client and seeking their informed consent, represents best professional practice because it upholds the principles of transparency and client centricity mandated by regulatory frameworks such as the CRRC Code of Conduct and relevant financial services legislation. This approach ensures that the client is fully aware of any potential influences on the advisor's recommendations and can make an informed decision about continuing the relationship or seeking alternative advice. It aligns with the ethical obligation to avoid conflicts of interest or, when unavoidable, to manage them openly and with client agreement. An incorrect approach would be to accept the gift without disclosure, assuming it does not influence recommendations. This fails to meet regulatory requirements for disclosure of inducements and gifts that could reasonably be perceived to impair objectivity. It constitutes an ethical failure by prioritizing personal benefit over client trust and potentially breaching fiduciary duties. Another incorrect approach would be to refuse the gift outright without considering the client's perspective or the specific nature of the gift. While seemingly cautious, this might be overly rigid and could alienate a vendor or create an unnecessary awkwardness without first assessing the actual risk of conflict and the client's potential willingness to accept such disclosures. A third incorrect approach, accepting the gift and only disclosing it if questioned, is a clear violation of proactive disclosure obligations and demonstrates a lack of integrity, as it implies an intent to conceal potential conflicts. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. This involves a proactive assessment of all relationships, gifts, and benefits that could influence professional judgment. Once identified, the next step is to evaluate the materiality of the conflict and its potential impact on client interests. The guiding principle should always be the client's best interest. If a conflict cannot be avoided, the professional must then consider the most transparent and client-protective course of action, which typically involves full disclosure and obtaining informed consent. This process ensures adherence to regulatory obligations and ethical standards, fostering trust and maintaining the integrity of the financial advisory profession. Question 7. Upon reviewing a client's recent transaction history, a compliance officer at a CRRC-regulated firm identifies a pattern of activity that, while not definitively illegal, raises concerns about potential market manipulation. The officer is aware of the firm's strict client confidentiality policies, but also understands the CRRC expectations for reporting suspicious activities. What is the most appropriate immediate course of action for the compliance officer? Option A. Directly contact the CRRC to report the suspected market manipulation without further internal consultation. Option B. Immediately escalate the concerns to the firm's internal legal counsel for guidance on reporting obligations and potential next steps. Option C. Advise the client directly that their transactions are being reviewed for potential market manipulation. Option D. Ignore the transaction pattern, assuming it is not a clear violation, and to avoid potential client disputes. The correct answer is B. Immediately escalate the concerns to the firm's internal legal counsel for guidance on reporting obligations and potential next steps. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential regulatory breaches. The firm's reputation and the trust placed in it by clients are at stake, requiring a nuanced approach that balances legal obligations with ethical considerations. Careful judgment is essential to navigate these competing demands without compromising either. The correct approach represents best professional practice because it prioritizes adherence to the CRRC regulatory framework while respecting client confidentiality to the greatest extent possible. By seeking internal legal counsel, the firm ensures that any reporting is done in a manner that is compliant with all applicable regulations and minimizes potential legal repercussions for both the client and the firm. This proactive and informed step demonstrates a commitment to regulatory integrity and responsible conduct. An incorrect approach that involves ignoring the potential breach fails to uphold the firm's duty to report suspicious activities as mandated by the CRRC. This inaction could lead to significant penalties for the firm and its employees, and it undermines the integrity of the financial markets. Another incorrect approach, such as immediately reporting the suspicion to the CRRC without internal consultation, could violate client confidentiality unnecessarily and potentially lead to unfounded accusations, damaging the client relationship and the firm's standing. A third incorrect approach, which is to directly confront the client about the suspected breach without legal guidance, risks escalating the situation, potentially leading to the destruction of evidence or further non-compliance, and could expose the firm to liability. Professionals should employ a decision-making framework that begins with identifying potential regulatory or ethical issues. This should be followed by an assessment of the severity and nature of the issue, consulting relevant internal policies and external regulations. Seeking advice from internal compliance or legal departments is a crucial step before taking any external action. Documenting all steps taken and decisions made is also paramount for accountability and future reference. Question 8. Process analysis reveals that a wealth management firm is actively seeking to expand its client base. A potential new client, introduced by an existing satisfied client, expresses a strong interest in high-growth, speculative investments. While the introducer vouches for the potential client's general financial stability, the firm has not yet conducted a formal suitability assessment. Given the firm's business development targets, what is the most appropriate course of action to ensure regulatory compliance and ethical conduct? Option A. Proceed with onboarding the client and executing initial trades based on the introducer's recommendation, deferring a detailed suitability assessment until after the first few transactions. Option B. Conduct a comprehensive suitability assessment, including a detailed review of the client's investment objectives, risk tolerance, financial situation, and investment knowledge before accepting the client and executing any trades. Option C. Accept the client's stated interest in speculative investments at face value and proceed with onboarding, assuming their financial stability is sufficient given the introduction. Option D. Inform the potential client that their interest in speculative investments is too high risk for the firm and decline their business without further inquiry. The correct answer is A. Proceed with onboarding the client and executing initial trades based on the introducer's recommendation, deferring a detailed suitability assessment until after the first few transactions. Explanation. This scenario presents a professional challenge due to the inherent conflict between a firm's desire to expand its client base and the stringent regulatory obligations to ensure suitability and prevent market abuse. The firm must navigate the delicate balance of identifying potential new business while upholding its fiduciary duties and adhering to the CRRC hiring assessment tests regulatory framework concerning client onboarding and ongoing suitability assessments. Careful judgment is required to distinguish between proactive business development and potentially reckless client acquisition. The correct approach represents best professional practice because it prioritizes regulatory compliance and client protection above immediate commercial gain. By conducting thorough due diligence, including assessing the client's investment objectives, risk tolerance, and financial situation, the firm adheres to the core principles of suitability mandated by the CRRC framework. This proactive stance minimizes the risk of mis-selling, regulatory breaches, and reputational damage, thereby safeguarding both the client and the firm. It demonstrates a commitment to ethical conduct and the long-term integrity of the financial markets. An incorrect approach that involves proceeding with the onboarding without adequate suitability checks fails to meet the fundamental requirements of the CRRC framework. This constitutes a regulatory failure as it bypasses essential risk management procedures designed to protect investors. Ethically, it is a breach of trust, as the firm is not acting in the client's best interests. Another incorrect approach, which involves accepting the client's self-declaration of risk tolerance without independent verification, also falls short. While seemingly efficient, it ignores the regulatory imperative for the firm to independently assess suitability, as a client may not fully understand their own risk profile or may misrepresent it. This can lead to unsuitable investments and subsequent client complaints or regulatory action. A third incorrect approach, which involves delaying the suitability assessment until after the initial transaction, is a severe regulatory and ethical failure. This is fundamentally contrary to the principle of know your client and the requirement for suitability to be established before any investment is made. It exposes the client to undue risk and the firm to significant regulatory penalties. Professionals should employ a decision-making framework that begins with a clear understanding of the relevant regulatory obligations. When faced with a situation involving potential new business, the first step is to identify and apply the specific client onboarding and suitability assessment procedures outlined by the CRRC framework. This involves a systematic review of the client's profile against established criteria. If any information is incomplete or unclear, the professional should seek clarification and further documentation rather than making assumptions. The decision to proceed should only be made when all regulatory requirements for suitability have been demonstrably met. If there is any doubt, It is always more prudent to err on the side of caution and seek guidance from compliance or senior management. Question 9. Examination of the data shows that a client's investment portfolio exhibits a moderate level of volatility, but the underlying reasons for this volatility are not immediately clear from the provided statements. The firm's risk assessment policy mandates a thorough understanding of the drivers of risk before recommending any portfolio adjustments. Which of the following approaches best aligns with the firm's risk assessment obligations and professional best practices in this scenario? Option A. Assume the volatility is a normal market fluctuation and proceed with standard portfolio rebalancing strategies based on the current asset allocation. Option B. Rely on the client's general comfort level with risk, as expressed in a previous conversation, to justify the current level of volatility and avoid further investigation. Option C. Focus solely on the historical volatility figures and recommend a conservative adjustment to reduce overall portfolio risk without investigating the root causes. Option D. Conduct further due diligence to identify the specific factors contributing to the portfolio's volatility, such as underlying asset characteristics, market conditions, or specific investment strategies, before making any recommendations. Correct answer is D. Conduct further due diligence to identify the specific factors contributing to the portfolio's volatility, such as underlying asset characteristics, market conditions, or specific investment strategies, before making any recommendations. Explanation. This scenario presents a professional challenge because it requires the assessment of risk in a context where the available data is incomplete and potentially misleading. The firm is obligated to conduct a thorough risk assessment as part of its regulatory compliance and client duty of care. The challenge lies in balancing the need for a comprehensive assessment with the practical limitations of data availability, ensuring that decisions are not based on assumptions that could lead to inadequate risk mitigation or client detriment. The correct approach represents best professional practice because it prioritizes a structured, evidence-based methodology for risk assessment, even with imperfect data. It acknowledges the limitations and seeks to address them proactively through further investigation and the application of professional judgment. This aligns with regulatory expectations for robust risk management frameworks, which demand a systematic process for identifying, analyzing, and evaluating risks. Ethically, it upholds the duty to act in the client's best interest by ensuring that potential risks are understood and managed appropriately. An incorrect approach that relies solely on readily available, potentially superficial data fails to meet regulatory requirements for due diligence. It risks overlooking significant underlying risks, which could lead to regulatory breaches and harm to clients. This demonstrates a failure to apply professional skepticism and a lack of commitment to a thorough risk assessment process. Another incorrect approach that involves making broad, unsubstantiated assumptions about risk levels without attempting to gather supporting evidence is also professionally unacceptable. This bypasses the core principles of risk assessment, which require a reasoned basis for conclusions. It can lead to misallocation of resources, inappropriate risk appetite, and ultimately, a failure to protect the firm and its clients from potential harm. This approach violates the ethical obligation to provide competent advice and service. The professional decision-making process for similar situations should involve a clear understanding of the regulatory mandate for risk assessment. This includes identifying the scope of the assessment, the types of risks to be considered, and the expected level of detail. Professionals should then gather all available data, critically evaluate its quality and completeness, and identify any gaps. Where data is insufficient, the next step is to determine the most appropriate methods for obtaining further information or for making informed judgments based on professional experience and industry best practices. This iterative process ensures that the risk assessment is as accurate and comprehensive as possible, leading to sound risk management strategies. Question 10. Performance analysis shows that a candidate for a critical role has a history of strong performance in previous, less regulated environments. During the risk assessment process, the hiring manager, who has known the candidate socially for several years and is aware of their positive reputation, is tempted to streamline the assessment by relying on their personal knowledge of the candidate's character and past successes, rather than conducting a full, documented risk evaluation against the CRRC established risk criteria, which approach to risk assessment is most professionally sound and compliant with regulatory expectations for objective evaluation. Option A. Expedite the process by accepting the hiring manager's informal assessment based on their long-standing personal acquaintance and positive perception of the candidate's character and past achievements. Option B. Conduct a comprehensive risk assessment using documented evidence, standardized criteria, and a structured evaluation process, ensuring all findings are recorded, even if it means a more time-consuming process than relying on personal knowledge. Option C. Focus the risk assessment on the candidate's stated enthusiasm for the role and their perceived ability to adapt quickly, assuming these factors mitigate inherent risks. Option D. Primarily rely on the candidate's self-assessment of their risk profile, supplemented by a brief informal discussion with the hiring manager to confirm general suitability. The correct answer is B. Conduct a comprehensive risk assessment using documented evidence, standardized criteria, and a structured evaluation process, ensuring all findings are recorded, even if it means a more time-consuming process than relying on personal knowledge. Explanation: this scenario presents a professional challenge because it requires balancing the need for timely and accurate risk assessment with the potential for bias introduced by pre-existing relationships. The CRRC hiring assessment test, focusing on risk assessment, expects candidates to demonstrate an understanding of how to conduct objective evaluations, even when faced with subjective influences. The core of the challenge lies in ensuring that the assessment of an individual's risk profile is based solely on relevant data and established criteria, rather than personal familiarity or perceived past performance that may not be fully documented or representative. The correct approach represents best professional practice because it prioritizes objectivity and adherence to established risk assessment methodologies. By focusing on documented evidence, standardized criteria, and a structured evaluation process, it minimizes the influence of personal bias and ensures consistency. This aligns with regulatory expectations for fair and equitable assessment, preventing arbitrary or discriminatory decision-making. Ethical considerations also mandate that individuals are evaluated based on merit and demonstrable risk factors, not on subjective impressions. An incorrect approach that relies on informal observations or past personal interactions without formal documentation fails to meet regulatory standards for due diligence and risk management. Such an approach is susceptible to confirmation bias, where pre-existing positive or negative perceptions unduly influence the current assessment. This can lead to inaccurate risk ratings, potentially resulting in either the hiring of unsuitable candidates or the rejection of qualified ones, both of which carry significant reputational and operational risks for the organization. Furthermore, it violates the ethical principle of fairness and can lead to claims of discrimination if the assessment process is perceived as arbitrary. Another incorrect approach that relies solely on the candidate's self-assessment without independent verification is also professionally unacceptable. While self-assessment can be a component of a broader evaluation, it is inherently subjective and may not accurately reflect an individual's true risk profile. Regulatory frameworks typically require a degree of independent verification and due diligence to ensure the accuracy of information used in decision-making. Relying exclusively on self-reported data leaves the organization vulnerable to misrepresentation and an incomplete understanding of potential risks. The professional decision-making process for similar situations should involve a structured, data-driven approach. This includes clearly defining the risk assessment criteria, gathering relevant and verifiable information, applying standardized evaluation tools, and documenting the entire process. Professionals should be trained to identify and mitigate potential biases, and where personal relationships exist, they should recuse themselves from the assessment or ensure a robust oversight mechanism is in place to maintain objectivity. The focus should always be on the evidence and the established framework, not on personal feelings or informal knowledge. Question 11. Benchmark analysis indicates that a firm is considering a new product launch in a rapidly evolving market. The internal risk team has identified several potential risks, including market volatility, regulatory changes, and operational execution challenges. The firm needs to select an appropriate risk assessment approach to evaluate these risks before proceeding with the launch. Which of the following approaches best aligns with sound risk management principles in this context? Option A. Implementing a highly complex multi-factor quantitative model that requires extensive historical data which is not readily available for this specific market. Option B. assigning the entire risk assessment task to an intern with minimal prior experience in risk management, with no defined oversight process. Option C, solely relying on a backward-looking statistical analysis of similar product launches from 5 years ago to predict future risk levels. Option D, employing a qualitative risk assessment matrix that prioritizes risks based on their likelihood and impact, supplemented by expert judgment for emerging threats and scenario planning for significant potential disruptions. The correct answer is D, employing a qualitative risk assessment matrix that prioritizes risks based on their likelihood and impact, supplemented by expert judgment for emerging threats and scenario planning for significant potential disruptions. Explanation: scenario analysis. This scenario presents a professional challenge because it requires an individual to move beyond a superficial understanding of risk assessment and apply it to a dynamic, real-world situation. The challenge lies in identifying the most appropriate risk assessment methodology when faced with incomplete information and potential biases. A superficial approach might lead to the selection of a method that is either overly simplistic for the complexity of the risks or overly complex and resource-intensive, neither of which would be effective. Careful judgment is required to balance the need for thoroughness with practical constraints. Correct approach analysis. The correct approach involves selecting a risk assessment methodology that is proportionate to the complexity and potential impact of the identified risks, while also considering the availability of data and resources. This aligns with the principles of effective risk management, which emphasize practicality and relevance. A structured, yet flexible approach allows for the identification, analysis, and evaluation of risks in a way that informs decision-making without becoming an administrative burden. This demonstrates an understanding that risk assessment is a tool to support business objectives, not an end in itself. Regulatory frameworks often mandate a risk-based approach, requiring firms to identify and manage risks that could threaten their objectives, and this approach directly supports that mandate by ensuring the assessment is fit for purpose. Incorrect approach is analysis. One incorrect approach would be to solely rely on historical data without considering emerging risks or changes in the operating environment. This fails to acknowledge that past performance is not always indicative of future results and can lead to a false sense of security or an underestimation of new threats. This approach is ethically questionable as it could lead to inadequate risk mitigation, potentially harming clients or the firm itself. It also fails to meet regulatory expectations for proactive risk identification. Another incorrect approach would be to adopt a highly complex quantitative model without sufficient data or expertise to implement it effectively. This can lead to inaccurate results, wasted resources, and a lack of confidence in the assessment. It demonstrates a misunderstanding of the practical application of risk assessment tools and can be seen as a failure to exercise due diligence in selecting appropriate methodologies. This approach could also be seen as a breach of professional duty by not using resources efficiently or by producing unreliable risk assessments. A further incorrect approach would be to delegate the entire risk assessment process to junior staff without adequate oversight or training. This abdicates responsibility and increases the likelihood of errors or omissions. It is a failure of leadership and professional accountability, potentially leading to significant regulatory breaches and ethical lapses if critical risks are missed. Professional reasoning. Professionals should approach risk assessment by first understanding the context and objectives of the assessment. This involves identifying the scope of risks to be considered and the potential impact of those risks. Next, they should evaluate available methodologies, considering their suitability for the specific risks, the quality and availability of data, and the resources required for implementation. The chosen methodology should be proportionate to the risk profile. Throughout the process, professionals must maintain a critical perspective, challenge assumptions, and ensure that the assessment is regularly reviewed and updated to reflect changes in the environment. This iterative and adaptive approach ensures that risk management remains effective and aligned with regulatory and ethical standards. Question 12. Analysis of how an advisor should approach a client who expresses a strong desire for investments with the highest potential returns, while simultaneously demonstrating limited understanding of market volatility and investment risks, in the context of CRRC hiring assessment test expectations for responsible financial advice. Option A. Proceed with recommending the highest performing products available, assuming that a client seeking high returns is inherently comfortable with significant risk. Option B. Prioritize explaining the potential upside of the highest return products, downplaying the associated risks to encourage the client's investment enthusiasm. Option C. Conduct a detailed risk tolerance assessment, exploring the client's capacity to absorb losses, their investment knowledge, and their financial goals beyond just high returns. Before recommending any product, Option D. Focus on the products that have recently shown the most impressive returns, as this indicates a strong likelihood of future success and client satisfaction. The correct answer is C. Conduct a detailed risk tolerance assessment, exploring the client's capacity to absorb losses, their investment knowledge, and their financial goals beyond just high returns, before recommending any product. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent uncertainty in predicting future market movements and the potential for significant financial impact on clients. The firm's duty of care requires advisors to act in the best interests of their clients, which includes providing advice that is suitable and considers the client's risk tolerance and financial objectives. The pressure to generate revenue through product sales can create a conflict of interest, making objective risk assessment crucial. The advisor must navigate this conflict by prioritizing client well-being over immediate sales targets. Correct approach analysis. The correct approach involves a comprehensive, client-centric risk assessment that goes beyond superficial questioning. This aligns with the CRRC hiring assessment test's emphasis on regulatory compliance and ethical conduct. Specifically, it reflects the principles of suitability and client protection mandated by financial services regulations. A thorough assessment requires understanding the client's financial situation, investment experience, knowledge of financial markets, and their capacity to bear losses. This approach ensures that any recommended investment product is appropriate for the individual client, thereby fulfilling the advisor's fiduciary duty and adhering to regulatory requirements designed to prevent mis-selling and protect consumers. Incorrect approaches analysis. Focusing solely on the client's stated desire for high returns without a corresponding deep dive into their risk tolerance and capacity for loss is a significant regulatory and ethical failure. This approach prioritizes sales over suitability, potentially exposing the client to unacceptable levels of risk. It breaches the duty of care and could lead to breaches of conduct rules requiring advisors to act honestly, fairly, and professionally in accordance with the best interests of their clients. Recommending a product based on its popularity or recent performance without a personalized risk assessment is another failure. Market trends are not indicative of individual suitability. This approach ignores the client's unique circumstances and can lead to inappropriate investment decisions, potentially causing financial harm and violating regulatory expectations for personalized advice. Assuming that a client with a high income can automatically tolerate high risk is a dangerous generalization and a failure of due diligence. Income is only one factor in risk tolerance. Other elements like investment experience, knowledge, and emotional response to market volatility are equally, if not more, important. This assumption can lead to unsuitable recommendations and a breach of the advisor's obligation to conduct a thorough and individualized assessment. Professional reasoning. Professionals should adopt a structured decision-making process that begins with understanding the client's objectives and constraints. This involves active listening and probing questions to uncover their true risk profile, not just their stated preferences. The next step is to match these findings with suitable products, always prioritizing the client's best interests. If a conflict arises between potential sales and client suitability, the client's interests must always take precedence. Regular review of client portfolios and risk profiles is also essential to ensure ongoing suitability. This systematic approach, grounded in regulatory requirements and ethical principles, forms the bedrock of professional conduct in financial advisory. Question 13. Market research demonstrates that the financial services landscape is increasingly dynamic, with new technologies and evolving client expectations constantly reshaping the competitive environment. A firm is tasked with developing its approach to risk assessment for the upcoming fiscal year. Which of the following methodologies best aligns with the principles of effective and compliant risk management in this context? Option A. Relying solely on external consultants to conduct the risk assessment, with minimal internal involvement or oversight. Option B. Prioritizing the identification and assessment of risks based on their potential impact and likelihood, considering both historical data and emerging trends. and developing targeted mitigation strategies. Option C, focusing exclusively on risks that have materialized in previous years, assuming that past performance is the most reliable indicator of future threats. Option D, creating an exhaustive list of every conceivable risk, no matter how remote, without any attempt to prioritize or stratify their potential impact. The correct answer is B, prioritizing the identification and assessment of risks based on their potential impact and likelihood, considering both historical data and emerging trends, and developing targeted mitigation strategies. Explanation: this scenario presents a professional challenge because it requires balancing the need for proactive risk identification with the practical limitations of available resources and the potential for overanalysis. The firm must develop a robust risk assessment framework that is both comprehensive and actionable, avoiding the pitfalls of either neglecting emerging threats or becoming paralyzed by an exhaustive, but ultimately unmanageable, list of potential risks. The correct approach represents best professional practice because it emphasizes a structured, systematic, and forward-looking methodology for risk assessment. This aligns with regulatory expectation for firms to maintain sound risk management systems. Specifically, it involves identifying potential risks, assessing their likelihood and impact, and then developing appropriate mitigation strategies. This process ensures that resources are allocated effectively to address the most significant threats, thereby safeguarding the firm and its clients. It also demonstrates a commitment to regulatory compliance by proactively managing potential issues before they materialize. An incorrect approach that focuses solely on historical data without considering emerging trends would be professionally unacceptable. This failure stems from a lack of foresight and an inability to adapt to evolving market conditions, potentially leading to the firm being blindsided by new risks. Ethically, this could be seen as a dereliction of duty to clients who expect their investments and assets to be managed with due diligence against all foreseeable threats. Another incorrect approach, which involves an overly granular and exhaustive risk cataloging without prioritization, is also professionally flawed. While thoroughness is important, an unmanageable list of risks dilutes focus and makes effective mitigation impossible. This can lead to a false sense of security, as critical risks might be lost in the noise. From a regulatory perspective, this approach fails to demonstrate effective risk management, as it does not lead to actionable strategies. The professional decision-making process for similar situations should involve a cyclical approach. First, identify potential risks based on internal data, market intelligence, and expert judgment. Second, assess the likelihood and potential impact of each identified risk. Third, prioritize risks based on their severity and the firm's risk appetite. Fourth, develop and implement appropriate control measures and mitigation strategies. And finally, regularly review and update the risk assessment to account for changes in the internal and external environment. This iterative process ensures continuous improvement in risk management capabilities. Question 14. Market research demonstrates that a firm's strategic objectives are increasingly exposed to a complex and evolving risk landscape. To address this, the firm is developing a new risk assessment framework. Which of the following approaches best aligns with regulatory expectations and professional best practices for identifying and prioritizing potential threats to the firm's success? Option A, a process that exclusively relies on analyzing historical loss data to identify patterns and predict future occurrences of known risks. Option B, a methodology that systematically identifies potential risks, assesses their likelihood and potential impact on business objectives, and prioritizes them for mitigation based on this analysis. Option C, a system where risk assessment is primarily conducted by junior analysts with minimal senior management involvement or strategic direction. Option D, an approach that aims to document and analyze every conceivable minor risk, regardless of its potential impact or likelihood, to ensure no detail is overlooked. The correct answer is B, a methodology that systematically identifies potential risks, assesses their likelihood and potential impact on business objectives, and prioritizes them for mitigation based on this analysis. Explanation: this scenario presents a professional challenge because it requires balancing the need for proactive risk identification with the practical limitations of resource allocation and the potential for overanalysis. The firm must develop a risk assessment framework that is comprehensive enough to identify significant threats to its business objectives, but also efficient enough to be implemented effectively. The core of the challenge lies in determining the appropriate level of detail and the most effective methodologies for assessing risks without becoming bogged down in minutiae or overlooking critical, albeit less probable, events. The correct approach represents best professional practice because it emphasizes a structured, systematic, and forward-looking methodology for risk assessment. This aligns with regulatory expectations that firms should have robust risk management systems in place to identify, assess, and mitigate potential threats. By focusing on the likelihood and impact of identified risks, and then prioritizing them based on their potential to disrupt business objectives, the firm can allocate resources effectively to manage the most significant threats. This proactive stance is ethically sound as it demonstrates a commitment to the firm's stability, its clients, and the broader financial system. An incorrect approach that relies solely on historical data without considering emerging threats would be professionally unacceptable. This fails to meet regulatory requirements for forward-looking risk assessment and could lead to a false sense of security. It ignores the dynamic nature of the financial markets and the potential for unforeseen events, representing an ethical failure to adequately protect the firm and its stakeholders. Another incorrect approach that involves an overly granular and exhaustive analysis of every conceivable minor risk would be professionally inefficient and impractical. While thoroughness is important, an unfocused approach can lead to resource depletion, paralysis by analysis, and a failure to prioritize genuinely significant risks. This demonstrates a lack of professional judgment in resource allocation and strategic risk management, potentially leading to the neglect of more critical issues. A third incorrect approach that delegates risk assessment entirely to junior staff without adequate oversight or senior management buy-in would also be professionally deficient. This undermines the accountability and ownership required for effective risk management. It fails to leverage the experience and strategic perspective of senior leadership, which is crucial for understanding the firm's risk appetite and its overall strategic objectives. This can lead to a disconnect between risk assessment findings and strategic decision-making, representing an ethical lapse in governance. The professional decision-making process for similar situations should involve a cyclical approach. First, defining the scope and objectives of the risk assessment in alignment with the firm's strategic goals. Second, identifying potential risks through a combination of brainstorming, expert judgment, and data analysis, considering both internal and external factors. Third, assessing the likelihood and impact of these risks, often using qualitative or semi-quantitative methods. Fourth, prioritizing risks based on their potential severity and the firm's risk appetite. Fifth, developing and implementing appropriate mitigation strategies. Finally, continuously monitoring and reviewing the risk landscape and the effectiveness of mitigation efforts. This iterative process ensures that risk assessment remains relevant and effective. Question 15. Research into the initial screening of candidates for a critical role within a regulated financial services firm reveals that while some candidates have strong academic backgrounds, information regarding their practical experience in handling sensitive client data is limited. Which approach to risk assessment is most appropriate in this scenario? Option A. Prioritize identifying areas where information is lacking and develop a plan to gather further details or conduct targeted assessments to understand potential risks related to data handling. Option B. Assume that strong academic backgrounds imply competence in handling sensitive data and proceed with the assessment based on this assumption. Option C. Focus solely on the candidate's past performance in academic settings, as this is the most readily available and objective data. Option D. Conduct a broad, generalized risk assessment that applies to all candidates regardless of the specific role's data handling requirements. Correct answer is A. Prioritize identifying areas where information is lacking and develop a plan to gather further details or conduct targeted assessments to understand potential risks related to data handling. Explanation. This scenario presents a professional challenge because it requires an individual to move beyond a superficial understanding of risk assessment to a nuanced application within the CRRC hiring assessment tests specific regulatory context. The challenge lies in identifying the most appropriate method for assessing risk when faced with incomplete information, balancing the need for thoroughness with practical constraints, and ensuring compliance with the implied regulatory framework governing hiring assessments. Careful judgment is required to select an approach that is both effective in identifying potential risks and ethically sound, avoiding biases or shortcuts that could lead to unfair hiring decisions. The correct approach represents best professional practice because it acknowledges the inherent limitations of initial data and prioritizes a structured, iterative process for risk identification. This aligns with the principles of good governance and responsible assessment, which demand that potential risks are not overlooked due to expediency. By focusing on identifying potential areas of concern and then seeking further information, this method ensures a more robust and defensible assessment, minimizing the likelihood of overlooking critical risk factors that could impact the suitability of a candidate. This proactive and investigative stance is ethically imperative in hiring processes. An incorrect approach that relies solely on readily available information without further investigation fails to meet the professional standard of due diligence. This can lead to regulatory or ethical failures by potentially overlooking significant risks that are not immediately apparent, thus creating an unfair assessment process. Another incorrect approach that prioritizes speed over thoroughness, perhaps by making assumptions or using broad generalizations, risks introducing bias and failing to identify specific, relevant risks for the role. This violates the ethical obligation to assess candidates on their individual merits and potential risks. A third incorrect approach that focuses exclusively on past performance without considering future potential or contextual factors can also be problematic, as it may not adequately assess the candidate's ability to adapt to new challenges or environments, thus failing to identify emerging risks. Professionals should employ a decision-making framework that begins with understanding the specific context and objectives of the assessment. This involves identifying the types of risks relevant to the role and the organization. The next step is to consider the available information and its limitations. Based on this, a preliminary assessment can be made, followed by a plan to gather further information or conduct deeper analysis where potential risks are identified. This iterative process, guided by regulatory requirements and ethical principles, ensures a comprehensive and fair evaluation. Question 16. The efficiency study reveals that a significant portion of operational costs is attributed to manual data reconciliation processes. Management is keen to implement an automated solution to streamline these tasks and reduce headcount. Which of the following represents the most prudent and compliant approach to addressing this finding? Option A. Conduct a thorough risk assessment of the proposed automation, including an evaluation of data integrity, system security, and the impact on existing regulatory reporting. Develop a detailed implementation plan with robust testing and validation phases, and ensure all changes are documented and approved through the firm's established change management and governance procedures. Option B. Focus solely on the potential cost savings and headcount reduction benefits identified in the efficiency study, and implement the automation with minimal disruption to current workflows, assuming no significant risks will arise. Option C. Immediately proceed with the implementation of a new automated reconciliation system, prioritizing the fastest and most cost-effective solution available to achieve immediate headcount reductions. Option D. Delegate the decision-making for the automation solution to the operations team, trusting their judgment to select the most efficient tools without extensive oversight from compliance or risk departments. The correct answer is A. Conduct a thorough risk assessment of the proposed automation, including an evaluation of data integrity, system security, and the impact on existing regulatory reporting. Develop a detailed implementation plan with robust testing and validation phases, and ensure all changes are documented and approved through the firm's established change management and governance procedures. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency with the imperative to maintain robust internal controls and adhere to regulatory expectations regarding risk management. The firm's reputation and regulatory standing are at stake if controls are perceived as weakened, even in the name of cost savings. Careful judgment is required to identify solutions that enhance efficiency without compromising compliance or introducing undue risk. The correct approach represents best professional practice because it prioritizes a systematic, risk-based evaluation of proposed changes. This aligns with regulatory expectations for firms to have effective systems and controls in place to manage risks. By involving relevant stakeholders, conducting thorough impact assessments, and ensuring that any changes are documented and approved through established governance processes. The firm demonstrates a commitment to responsible innovation and regulatory compliance. This proactive and structured methodology minimizes the likelihood of unintended consequences and ensures that efficiency gains do not come at the expense of client protection or market integrity. An incorrect approach that focuses solely on immediate cost reduction without a comprehensive risk assessment fails to meet regulatory obligations. This could lead to a breach of rules requiring adequate systems and controls, potentially resulting in supervisory action. Another incorrect approach that bypasses established change management procedures, even with good intentions, undermines the firm's governance framework. This can create operational vulnerabilities and make it difficult to demonstrate compliance during regulatory reviews. A third incorrect approach that implements changes without adequate testing or validation risks introducing errors or system failures, which could have significant financial or reputational repercussions and violate principles of due diligence. Professionals should employ a decision-making framework that begins with understanding the proposed changes' objectives and potential benefits. This should be followed by a thorough risk assessment, identifying potential regulatory, operational, and reputational risks. Next, evaluate the proposed solutions against these risks in the firm's existing control environment. Engage relevant departments, e.g., compliance, risk, IT operations, to gather input and ensure alignment. Finally, document the decision-making process, the rationale for the chosen approach, and any mitigation strategies implemented. This structured process ensures that decisions are informed, defensible, and aligned with both business objectives and regulatory requirements. Question 17. Market research demonstrates a significant increase in demand for specialized financial advisory services within a particular sector. A financial advisor, who currently manages a robust portfolio of long-standing clients, is presented with an opportunity to engage with several high-potential prospective clients in this growing sector. The advisor is concerned about how to best allocate their time and resources to pursue these new opportunities without negatively impacting the service levels and satisfaction of their existing client base. Which of the following represents the most appropriate and ethically sound approach for the financial advisor in this situation? Option A. Leverage insights and strategies developed for existing clients to quickly tailor proposals for the prospective clients, aiming to expedite the onboarding process. Option B. Prioritize ensuring all current client needs are fully met and that all regulatory obligations are meticulously adhered to before dedicating significant time to pursuing new business opportunities. Option C. Make ambitious promises to the prospective clients about the level of immediate attention and personalized service they will receive, assuming that existing client demands can be managed flexibly. Option D. Immediately shift focus and resources towards securing the new prospective clients, as the potential for growth in the new sector is substantial and could significantly enhance the firm's revenue. The correct answer is B. Prioritize ensuring all current client needs are fully met and that all regulatory obligations are meticulously adhered to before dedicating significant time to pursuing new business opportunities. Explanation. This scenario presents a professional challenge because it requires an individual to balance the pursuit of new business opportunities with the ethical and regulatory obligations to existing clients. The core tension lies in allocating limited resources and attention effectively without compromising the quality of service or breaching fiduciary duties. Careful judgment is required to ensure that the pursuit of potential new clients does not detract from the diligent management of current client portfolios, which could lead to missed opportunities or inadequate risk management for those already served. The correct approach represents best professional practice because it prioritizes the fulfillment of existing commitments and regulatory requirements before aggressively pursuing new business. This aligns with the fundamental ethical duty of care owed to current clients and the regulatory imperative to act in their best interests. By first ensuring that all current client needs are met and that compliance standards are maintained, the professional demonstrates integrity and a commitment to established relationships. This proactive stance also mitigates potential conflicts of interest and avoids situations where the pursuit of new business could inadvertently harm existing clients. An incorrect approach that involves neglecting existing client responsibilities to focus on new leads is a direct violation of professional conduct rules. This demonstrates a failure to uphold fiduciary duties and could be construed as a breach of contract or trust. Such an approach prioritizes potential future gains over present obligations, which is ethically unsound and likely to contravene regulations governing client care and service standards. Another incorrect approach, which involves making promises to prospective clients that cannot be realistically fulfilled due to existing commitments, constitutes misrepresentation and potentially deceptive practices. This not only damages the professional's reputation, but also exposes them to regulatory scrutiny and sanctions for misleading potential clients. It fails to acknowledge the practical constraints of resource allocation and the importance of delivering on promises. A further incorrect approach, such as using confidential information gained from existing clients to solicit similar business from prospective clients, represents a serious breach of confidentiality and a potential conflict of interest. This undermines client trust and violates ethical principles designed to protect sensitive information. The professional decision-making process for similar situations should involve a clear assessment of current workload and resource availability. Professionals should first evaluate their capacity to take on new responsibilities without compromising existing duties. This includes understanding the time and attention required for both new business development and ongoing client management. A structured approach to prioritizing tasks, setting realistic timelines, and communicating transparently with both existing and prospective clients is crucial. When faced with competing demands, professionals should err on the side of caution, ensuring that existing client obligations are fully met before committing to new ventures. This often involves setting clear boundaries and declining opportunities that would strain resources to a point of compromising service quality or ethical standards. Question 18. Which approach would be most appropriate for a financial advisor who receives information suggesting a client may be engaging in insider trading, considering the firm's obligation to maintain client confidentiality and comply with market abuse regulations? Option A. Conduct a discreet internal review to gather further evidence and consult with the firm's compliance department before taking any external action. Option B. Inform the client directly about the suspicion and ask for an explanation, potentially jeopardizing the investigation. Option C. Ignore the information as it is merely a suspicion and not concrete proof of wrongdoing. Option D. Immediately report the suspicion to the relevant regulatory authorities without informing the client. The correct answer is D. Immediately report the suspicion to the relevant regulatory authorities without informing the client. Explanation. This scenario presents a challenge in balancing client confidentiality with the need to ensure compliance with regulatory reporting obligations. The firm has received information that could indicate potential market abuse. Directly disclosing this to the client without a clear regulatory trigger or internal investigation could breach confidentiality and damage the client relationship. Conversely, ignoring the information could lead to regulatory breaches and harm market integrity. The professional challenge lies in navigating these competing interests ethically and legally. The correct approach represents best professional practice because it prioritizes a structured, evidence-based response that aligns with regulatory expectations for handling potential market abuse. It involves internal escalation and investigation to gather sufficient grounds for reporting, thereby respecting client confidentiality until a clear regulatory obligation arises. This aligns with principles of due diligence and responsible conduct expected of financial professionals. An incorrect approach that involves immediate, unsubstantiated disclosure to the client fails to uphold client confidentiality and could be seen as an accusation without due process. This could lead to reputational damage for both the client and the firm. Another incorrect approach, which is to ignore the information entirely, represents a failure to comply with market abuse regulations and a dereliction of the firm's duty to maintain market integrity. This could result in significant regulatory penalties and sanctions. A third incorrect approach, which is to report the suspicion to regulators without any internal verification, could lead to unnecessary investigations, damage client relationships, and potentially be seen as an overreaction if the suspicion is unfounded. Professionals should adopt a decision-making framework that begins with identifying potential regulatory red flags. This should be followed by an internal assessment to gather facts and evidence. If the evidence supports a suspicion of market abuse, the next step is to follow the firm's established procedures for reporting such concerns to the relevant compliance or legal departments, who will then determine the appropriate course of action, including potential reporting to regulatory authorities, while always considering client confidentiality within the bounds of the law. Question 19. The review process indicates that a junior analyst has encountered a discrepancy in client financial data during a preliminary assessment. The analyst is unsure of the exact nature of the transaction that led to the discrepancy and has access to some internal notes that are vague and potentially outdated. The analyst is considering several methods to resolve this issue before proceeding with the assessment. Option A. Make an educated guess based on the vague internal notes and proceed with the assessment, documenting the assumption. Option B. Ask a colleague in a different department who may have had tangential involvement with the client to provide their recollection of the transaction. Option C. Contact the client directly to request clarification on the specific transaction and any supporting documentation. Option D. Attempt to infer the nature of the transaction by cross-referencing with other, unrelated client accounts. Correct answer is C. Contact the client directly to request clarification on the specific transaction and any supporting documentation. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient data collection with the imperative to maintain data integrity and client confidentiality, as mandated by CRRC regulations. The core of the challenge lies in determining the most appropriate method for gathering information without compromising the accuracy or security of sensitive client data. Careful judgment is required to select an approach that is both effective and compliant. The correct approach represents best professional practice because it prioritizes direct, verified communication with the client. This method ensures that information is obtained directly from the source, minimizing the risk of misinterpretation or data alteration. It also aligns with CRRC guidelines on client interaction and data handling, which emphasize accuracy, completeness, and the protection of client information. By seeking clarification directly, the professional demonstrates diligence and a commitment to upholding regulatory standards. An incorrect approach that involves inferring information based on incomplete data is professionally unacceptable. This failure stems from a violation of CRRC principles of accuracy and due diligence. Inferring information can lead to factual errors, potentially misrepresenting the client's situation and leading to incorrect advice or actions, which could have regulatory consequences. Another incorrect approach, such as relying on informal, unverified third-party information, represents a significant ethical and regulatory failure. CRRC regulations strictly prohibit the use of unsubstantiated information for decision-making. This method introduces a high risk of misinformation and breaches confidentiality if the third party is not authorized to share such details. It demonstrates a lack of professional skepticism and a disregard for established data verification protocols. A further incorrect approach, which involves documenting assumptions as facts without client confirmation, is also professionally unsound. This directly contravenes CRRC requirements for factual accuracy and transparency. Making and documenting assumptions as confirmed facts can mislead internal stakeholders and, more critically, the client, potentially leading to significant compliance breaches and reputational damage. The professional decision-making process for similar situations should involve a systematic evaluation of available information, a clear understanding of CRRC regulatory obligations regarding data accuracy, client confidentiality, and due diligence, and a commitment to seeking direct, verifiable confirmation for any critical data points. When faced with ambiguity or incomplete information, the default professional action should be to seek clarification from the primary source, rather than relying on inference, assumption, or unverified external input. Question 20. The analysis reveals that a client, known for their complex international business dealings, has recently requested a series of unusually structured transactions involving multiple offshore entities. While the stated purpose of these transactions appears legitimate on the surface, the pattern of activity, the use of shell corporations, and the lack of clear economic rationale raise concerns about potential money laundering or evasion of reporting requirements. The professional handling these transactions is aware of the firm's strict adherence to regulatory guidelines concerning suspicious activity reporting. Which of the following represents the most appropriate course of action for the professional in this situation? Option A. Directly question the client about the underlying purpose of the transactions and their potential implications for regulatory compliance. Option B. Report the suspicious activity directly to the relevant regulatory authority without informing the firm's compliance department. Option C. Proceed with the transactions as requested by the client, assuming their business activities are legitimate and not interfering with regulatory obligations. Option D. Immediately escalate the concerns and all relevant documentation to the firm's compliance department for further investigation and assessment. The correct answer is D. Immediately escalate the concerns and all relevant documentation to the firm's compliance department for further investigation and assessment. Explanation: this scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The CRRC hiring assessment test, operating under a specific regulatory framework, assumed to be a fictional jurisdiction for this example, as no specific jurisdiction was provided, but adhering to the spirit of exam-specific regulations, mandates that employees act with integrity and report potential breaches of financial regulations. The difficulty lies in discerning when a client's actions cross the threshold from legitimate, albeit unusual, behavior to a potential attempt to circumvent regulatory requirements. A professional must balance the duty of loyalty to the client with their statutory and ethical responsibilities to the financial system. The correct approach represents best professional practice because it prioritizes adherence to the regulatory framework's anti-money laundering (AML) and suspicious activity reporting (SAR) provisions. By escalating the matter internally to the compliance department, the professional is fulfilling their duty to report potential illicit activity without making a premature judgment or violating client confidentiality unnecessarily. This aligns with the principle of innocent until proven guilty, while ensuring that regulatory obligations are met. The compliance department is equipped to conduct further investigation and make the formal determination on whether a SAR is warranted, thereby mitigating individual risk and ensuring a standardized, compliant response. An incorrect approach that involves ignoring the client's actions would be a direct violation of regulatory obligations to report suspicious transactions. This failure to act could lead to severe penalties for both the individual and the firm, and it undermines the integrity of the financial system. Another incorrect approach, such as directly confronting the client about suspicions without proper internal consultation, could breach client confidentiality, alert the potential wrongdoer, and potentially compromise any subsequent investigation. This action would also bypass the established internal reporting procedures designed to ensure consistent and compliant handling of such matters. A third incorrect approach, such as reporting the suspicion to external authorities without first consulting the firm's compliance department, would violate internal policies and procedures, potentially creating unnecessary alarm and misallocating investigative resources. Professionals should employ a decision-making framework that begins with identifying potential red flags. Upon recognizing such flags, the next step is to consult internal policies and procedures regarding suspicious activity. If the situation warrants further scrutiny, the professional should escalate the matter to the designated compliance or legal department for expert review and guidance. This ensures that all actions taken are in accordance with the relevant regulatory framework and ethical standards, while protecting both the individual and the firm.